A red screen at 6 a.m. Not a fire, not an emergency, just a phone. You unlock it, half asleep, expecting a normal day. Then you see it. Every number, red. Your portfolio, your savings, the account you spent years building, bleeding. Your chest tightens, your thumb hovers over one word, sell. Every voice inside your head is screaming the same thing, get out, save what's left before it gets worse. But here is the part nobody talks about. Throughout history, some of the largest fortunes were built during the exact moments everyone else was running toward the exit. Same red screen, same fear, two completely different futures. Why? That is the story of every market crash that has ever happened. And by the end of this video, you will see it in a way most people never will. Let's start with something uncomfortable. Most people don't panic because of money. They panic because they feel out of control. A red screen doesn't just show losses, it shows something worse, a future they can no longer predict. And the human brain hates that more than almost anything else. Watch what happens. The screen turns red. The heart rate rises. The hands sweat. The mind starts telling stories. This is the beginning. It's all going to zero. I need to act now. But here's the strange part. Nothing has actually happened yet. No money has left the account. No decision has been made. The only real event is a number on a screen. And still, the fear feels real, loud, overwhelming. That is the trap. And here is the idea that changes everything. The crash itself is rarely the biggest danger. The biggest danger is the decision people make while they are scared. Losses on a screen are temporary. Decisions made in panic are permanent.
So what is a crash, really? Forget the news, forget the graphs, forget the noise. A crash is one simple thing, a sudden sharp drop in the price of stocks across the market. It usually happens because of one of three reasons. The first is a bubble. Imagine a balloon being filled with air. Every excited investor blows a little more into it. Prices climb far beyond what the business is actually worth. Nobody wants to stop. Everyone believes it will keep going up. Then one small pin, one nervous investor, one bad report. Pop. The second reason is a weakening economy. Prices in real life go up. Rent, food, fuel. People slow down their spending. Businesses earn less. Investors get nervous. Money quietly walks out the door. The third is the one no one sees coming. An unexpected shock. A war, a pandemic, a political earthquake. The world shifts overnight, and so do the markets. Bubbles, economic weakness, sudden shocks. Three engines, same result. A room full of red screens and racing hearts. If crashes feel new to you, that's only because they feel new every time. They aren't. Rewind to the year 2000. Investors were falling in love with anything connected to the internet. Then reality asked a simple question. Where are the profits? Most companies could not answer. The Nasdaq collapsed. But this is where the story changes. The people who lost the most were not the ones who owned the stocks. They were the ones who sold at the worst possible moment and never came back. Fast forward to 2008. Banks that looked untouchable cracked overnight. Families watched their homes turn into weights around their necks. Some sold in fear and locked in their losses forever. Others simply stopped looking at the news, kept their heads down, and waited. Then came 2020, a virus almost nobody had heard of. Empty streets, closed borders. Markets fell over 30% in just a few weeks. 3 completely different disasters, but the same human story underneath. The market falls, some people panic, some people study, and those 2 reactions decide who walks away wounded and who walks away wiser. Historically, major markets have recovered after severe crashes, although recovery times and outcomes have varied, sometimes months, sometimes many years. Nothing is guaranteed, but there is a rhythm. Fear, fall, silence, rebuild. And the people who understand that rhythm behave very differently from the people who don't.
Zoom into an apartment building. 2 people. Same city, same crash. The first one is frozen, eyes locked on the phone. Every notification feels like another slap. Every headline sounds louder than the last. The finger presses sell. A number that used to be a possibility becomes a permanent loss. Later that week, this person will remember the exact moment they gave up, and they will replay it in their head for years. Now zoom into the second apartment. Same screen, same red. But this person doesn't shout, doesn't cry, doesn't refresh the app 50 times. They put the phone down, they pour a coffee, they open a notebook. Not because they are stronger, not because they know the future, but because at some point they learned something the first person never did. The market doesn't reward the fastest hand, it rewards the calmest mind. One reacts to the storm, the other studies it. What most people misunderstand is why they lose during a crash. It is almost never the market. It is almost always 3 quiet mistakes. The first is panic selling. Imagine standing on a plane during heavy turbulence. It's shaking, it's loud. Every instinct tells you to jump out. But nobody jumps out of a plane because of turbulence. You breathe, you wait. It passes. Panic sellers jump. They turn a temporary drop into a permanent loss, and often, months later, they watch prices climb back up without them. The second mistake is trying to catch the exact bottom. People treat a crash like a puzzle they can outsmart. They wait for the perfect moment, the lowest possible price, the magic number. Some wait too long and miss it entirely. Others buy too early and watch prices fall even further. The market doesn't send text messages when the bottom arrives. Many long-term investors avoid this trap by doing something far less exciting, investing small amounts over time, not trying to be a genius, not trying to be a hero, just steady, quiet decisions when everyone else is loud. The third mistake is chasing anything that looks cheap. A crash makes everything look like a bargain, but cheap and valuable are not the same thing. Some falling companies are strong businesses temporarily on sale. Others are simply falling because they were never solid to begin with. Buying a stock only because the price dropped is like buying a car only because it's 50% off without checking if the engine still works. Panic, timing games, random bargains, 3 mistakes, endlessly repeated, in every crash, in every generation. Here's the part nobody talks about. A crash is not just a financial event. It's a mirror. It shows who has a plan and who doesn't, who studied and who just followed the crowd, who understands what they own and who was only hoping. The screen turns red, and everyone gets a chance to see themselves clearly. Some people see fear and freeze. Some people see fear and act on it.
And some people see fear and quietly recognize something else underneath it. A shift, a change in prices they had been watching for a long time. They don't celebrate, they don't cheer, they don't shout buy at a screen. They just observe, read, think, wait. Because they learned something most people never do. The market is not a casino. It is a conversation between fear and patience. And every crash is just another round of that conversation. So the next time you unlock your phone and see red, the next time your heart starts racing before your brain wakes up, the next time the news is screaming that the world is ending, remember what is really happening. A market crash doesn't only move numbers, it moves wealth, from the loud to the quiet, from the reactive to the prepared, from the ones who feel first to the ones who think first. Most people spend their lives fearing the next crash. Maybe not. Maybe the crash was never the real test. Maybe the real test was always the person holding the phone.